In Australia, there are three different ways in which our income tax could be calculated. So it could be calculated with rates that apply to residents. It could be calculated with rates that apply to non-residents or foreign residents, or it could be calculated using rates that apply to working holiday makers. So let's start with the rates that apply to residents. So these rates apply for the financial year 2023-24, but have been the same for a couple of years already. So this same math would apply to previous financial years, including 2022-23, in case you are wondering how much income tax you would pay when you lodge your financial return in a couple of months. But here you would see that there is a tax-free bracket for anyone who makes less than $18,200 in the year of July of 2022 to the 30th of June 2023, or 1st of July 23, 30th of June 24, and so on. The moment you make your $18,201, you do have to start paying tax on that. So in that case, you would pay 19 cents on that $18,201. So in any case, what you would do is take the amount of money that you made, your taxable income for the entire financial year, subtract the lower threshold that I am showing in this table, and multiply that difference by the rate. And to that result, you would add the fixed amount. Now, the fixed amount is simply the sum of the previous tax that you would have paid in the previous brackets. So for example, for the third bracket, the one that applies to people making 45,000 to 120,000, those 5,095, which is the fixed amount, would be the tax that you would pay on 45,000. As soon as you make $45,001, you would pay those 5,092 plus 32.5% on the additional dollar that you made over 45,000. And the same applies to the rest of the brackets. So here I have a couple of examples. Let's say that during the year you made $38,265. Based on these rates, you would have to pay $3,812.35, which would mean an effective tax rate of 9.96%. The effective tax rate, of course, refers to the amount of tax that you would actually pay on your income. These rates that we are seeing in the table are not the final rates, they are just the marginal tax rates. That means the tax rate that apply to the next dollar that we make. By the way, these resident rates apply also to people who don't necessarily have a permanent residency in Australia, but that are considered temporary residents. So for example, people here on a working visa who are going to be working in Australia, maybe not looking for a residency in Australia, they may even be thinking about returning to their own country after 6 months, a year, or something like that. But right now they would be temporary residents. These resident rates apply to them as well. Now, as for foreign residents, people that do not live in Australia perhaps, but are making money in Australia through a business or through many different kinds of sources, they would be paying a much larger tax. So these are the rates that would apply to them. As you can see, there is no tax-free bracket. As soon as they make $1 here in Australia, they would have to pay 32.5% of income tax in that dollar. As you can see, not only is there no tax-free bracket, but there is also no bracket taxed at 19% as there is for residents. Immediately, foreign residents are paying 32.5%. The rest of the bracket is identical with 37% from 120,000 to 180,000 and 45% from 180,000 and over. This all means, of course, that the fixed amount is different, is larger, but the fixed amount is calculated exactly the same. For the second bracket, the one that applies to people making between 120,000 to 180,000, those $39,000 are, of course, 32.5% of 120,000, which is the lower threshold of the bracket or the upper threshold of the previous bracket. So it's not just some random number that the ATO comes up with, is the tax that is paid in all of the previous brackets. So anyway, for example, let's take the same amount of money that we calculated before with $38,265. where a resident would have paid an effective tax rate of 9.96%, a total of $3,812.35. A foreign resident would have paid an effective tax rate of 32.5% for a total of $12,436.13. Now, there is also, and this applies to foreign residents as well, a working holiday maker tax rate. So this applies to foreign residents that come to Australia for only a small period of time. They hold a 417 or a 462 visa, and they would pay less tax than a foreign resident. So as you can see, there is still no tax-free bracket like there is for residents or temporary residents, but with this bracket there is a 15% starting rate that applies to the first $45,000 made. Immediately after that, they would pay 32.5% on any money made between $45,000 and $120,000, which is the same that a resident would pay, but of course, because there is no tax-free bracket, the fixed amounts are different. Notice that for people making between $45,000 and $120,000, inside of these working holiday makers brackets, the fixed amount is $6,750, which of course is 15% of $45,000, whereas for the same bracket of people making between $45,000 and $120,000 as residents, the fixed amount is $5,092, which is only 19% of $26,800, which is $45,000 minus $18,200, because the first $18,200 are tax free. So anyway, with the same example, a person who is a working holiday maker making $38,265 during the year would have an effective tax rate, of course, of 15% for a total income tax of $5,739.75. So there it is, the difference between these three different tax brackets that apply here in Australia. Hopefully this video is useful. I am actually going to leave this Excel file down in the description so you can just grab it, download it, make your own calculations, maybe figure out how much you should have paid or you're going to pay for income tax for this financial year in October when you lodge your tax return. But anyway, my washer has been very bad during, I should have just recorded upstairs, shouldn't I? Anyway, catch you on the next one, I guess.